Hello, Dominic.
Hi there.
Good to hear you. We can't see you. You want to stay hidden, right?
Yeah, I I just woke up, so I'm just like laying in my bed.
Yeah, I'm afraid I have my visage has to be up there all the time, so you have to look at me. So you're the lawyer, right?
Oh, that's my dad.
Oh, that was okay. Oh, you're both take.
Mhm.
Are you both taking this class?
Yeah.
Oh, how cool is that, huh?
Mhm.
Are you a future lawyer too, maybe? Or
No, I want to go into sports marketing. So right now I'm a business major, but I've always been interested in the law.
oh, that's great. Sports. Well, you know me. I'm the big sports fan here.
Mhm. Yeah, Dodgers, fingers crossed. I'm a big Dodgers fan, so.
I was 9 years old when the Dodgers left Brooklyn, and I still
Oh
remember
yeah.
the pain. So I'm not a Dodger fan,
Oh yeah. I
but
really wanted the Dodgers Yankees World Series. I thought that would have been pretty sweet, but
yeah, yeah. I tell you, when I was a kid, that was almost every year it seemed,
hmm
52, 53, 56, you know what I mean?
yeah,
55, 56,
yeah, a lot.
great,
hmm
great rivalry. All right, we'll
Yeah.
give it, let's see who else we have here. We'll give it another minute or so, and then we'll get going. Hi, Suda. Can you hear me?
Good good morning, Bob.
Okay, so we have two people hiding, which is okay. And it's now 10:01, and I think we're ready to roll. Okay. Pardon me. All right. We're up to chapter 6, right?
hmm
Correct.
Chapter 6. How did the test go for you guys, if I may ask?
Good.
You did okay, right, Suda?
It could be better.
I
It it
It
could
was
be better.
definitely
How
very tough.
I think it's like too much. Like I think I spent too much time on the calculation, so I didn't.
oh, okay.
Yeah.
Yeah. Yeah. Yeah. It's
Yeah,
easy
it
to
was
get
definitely
bogged
a
down
time
in the
thing.
numbers when you're a little rattled and pressed for time, right?
Right. Because I
Okay,
feel like I had so much time, so I spent a lot of time on one of them. The next thing I know, I was like,
How is the second midterm
two.
going to be different?
say it again, Dominic.
Oh, I was just wondering, how is the second midterm going to be different? Because the first one was 60 questions, 150 minutes, and this one's 40 questions, 100 minutes. Is it just going to have different, same format, but different
It'll still be,
chapters?
yeah, it'll still be multiple choice, but you'll have more like Suda was just saying here in this next test you're talking about. There'll be more calculations to do, and you'll get a feel for that as we go along. Okay,
Okay. Mm-hmm.
so all right, now we're done with accounting 110. Congratulations, you all passed accounting 110. So here
Mm-hmm.
we here we are. Chapter 6. Chapter 6 is going to take us into the balance sheet in a little bit of detail. We're going to look at cash and accounts receivables and revenues. Next chapter, we're going to look at inventory and cost of goods sold. And in chapter 8 will be fixed assets. So here we go, reporting sales, revenue, and cash. And before I go again, I did ask if you can see this, right? You can see it.
Mm-hmm. Yeah.
Yes.
Okay. All right. Back to the revenue principle. Remember, revenues recorded when earned, recorded when earned. Okay.
Mm-hmm.
We don't wait for the customer to pay us. And in this chapter here, we're selling everything for the most part on credit terms, meaning the customer is going to pay us probably in 30 days. And we're going to look at four things here, four things that impact our net income and gross not gross profit, yes, and also net income. Let's start with these three things you see here: credit card sales, sales discounts, sales returns, and allowances. Let me start with sales returns and allowances here. Well, they're going to make me start with the credit card sales. Okay. When you buy something at a store, you buy something for exactly $100 from Nordstrom's. The minute you swipe that check, that credit card of yours, Nordstrom is not going to get $100 in their bank. They're only going to get, say, $98 because the credit
Mhm.
card company charges a fee.
Yep.
Nordstrom still wants to record that $100 as a $100 sale, which it legitimately is. But they're going to offset that by the $2 credit card fee or credit card sales fee. That account, credit card fees, is a contra revenue account. And that's what we're talking about on this particular screen in front of you. These are contra revenue accounts. You never debit sales. I can't say that enough. You never debit sales, but you must reduce the gross sales, which is the amount you billed out, down to the net sales, which is the amount you think you're going to actually collect. So our sales that we bill out are going to be reduced. If anybody used a credit card, if anybody returned anything, you know, most of us have returned something to a store at one time or another and got credit for it, or an allowance where you maybe bring something back and the guy says, look, you paid 100 for it. How about you keep and I'll knock 25 off the price? That would be an example of an allowance. Sales discount has a very specific meaning that we're going to go into in a little bit of detail. It's not when you walk into a store and you see there's a sale, 20% off. And then bad debts expense is a whole different section here. So let's see what we're talking about. Credit cards. Companies want people to use their credit cards to increase sales, to avoid credit problems. You know, when somebody pays with a credit card, you're not going to get stuck if the guy's a bum. You don't have to worry about him paying you in the future. Obviously, no bad checks, no fraud. It's a lot easier. Credit card sales, and credit card sales are cash as far as I'm concerned, okay? Credit card sales. So when the sale is made, the company must pay a fee. Some companies, not companies so much, but small businesses, you might see a sign cash only, maybe a small restaurant. They don't want to pay the credit card fee, but you can argue they're limiting their growth if they're only going to sell to people who are going to pay in cash. The key thing, contra revenue accounts, credit card sales, sales returns and allowances, sales discounts, contra revenue accounts, okay? Contra revenue. Hey, is that Nicole? Hi, Nicole. We're just getting started here. I'm going to go back real briefly, just real quick. What we're just saying, Nicole, is we're talking about sales being reduced by these contra revenue accounts. Contra revenue accounts. You never debit sales, but you do debit these contra revenue accounts. So we were just talking about why companies use credit cards, you know, to increase their business, and it's easy and fast. Here we go. We'll continue. Sales discounts. Like I said before, this is not you walk into Albertsons and there's 25 cents off a box of cereal. This is called a sales discount. To the buyer, it's called a sales discount. It's the same thing. Sales discount. When companies purchase on an open account, they may be offered a sales discount. So let's make sure we know how to read this. You need to know this like the top of your head, and maybe you do by now. 2%, 10 days, 2% 10, net 30. That's how you read that. 2% 10, net 30. You get a 2% discount if you pay the bill within 10 days of the invoice, okay? So it encourages, companies do this to encourage early payment. We are offering you $2 off on every $100. So it's 2% 10, 2% 10 net, meaning otherwise you have to pay the whole bill in 30 days. So that's kind of an important thing to understand. 2% 10, net 30. It could be 3% 15, net 50, but the idea is 2% 10, net 30 is the classic. Here is a little digression, and I think this, I'm pretty sure this type of thing is on the test, and I actually really like this. Should you take a 2% discount today? What if I offered you, what if you bought something for me for $100? Would you just pay me in 30 days because it's only $2, or do you think you should take the $2 discount? What, anybody have any ideas on that?
Discount 10.
Nobody has ideas. Nobody. All
Well,
right. Oh,
saving is a saving.
yeah, but it's a big, 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 big saving because, and here's where we're going to talk about. Look at this. When you gave up your money for 20 days, right? Your choice was to pay in 10 or 30 days. You chose to save $2 by paying in 10. So you gave up the money for 20 days. That's 20 days that you earned 2%. That's 20 days, right? 20 days is the amount you saved. You saved $2, but you only had to pay $98. So right away, it's actually a 2.04%. But that was just for 20 days. How many days are in a year? 365, right? Look at this. 365 divided by that. You're actually earning 37.2% by taking that 2% discount. Do you think you can go into a bank today, hand them $100 or hand them $98 and walk out a day later with 100, or give them 100 and walk out with 102? No. In these days of low interest rates, that's an amazing discount to get. Okay.
Yeah.
All right, let's get into our contra revenue accounts. We started off with credit card fees, sales returns and allowances. Sales returns and allowances. Contra revenue, meaning it has a debit balance even though it's a sales account. Contra sales, contra revenue. And we were saying before, we all return things we've all returned things to a store before. And when that happens, the company who is getting the goods returned to them, they have to recognize the loss of that sale. But you can never debit sales. We always want that gross sales number to stay untouched. So what they do is debit these contra revenue accounts. Contra revenue, sales returns, you returned it, maybe it was damaged and they gave you a deal or something, gave you a little bit of a more off. Look at this grid here. Now on the test, Dominic, you were asking a little bit earlier about, there's only, I think you said there's only 40 questions on the next exam. Well, one reason is we expect you to be very conversant with some of these templates here. Net sales. Companies record credit card discounts, sales discounts, returns, and allowance separately. Management wants to know, how much are we losing in credit cards? How much are we giving away in sales discounts? Why are we giving away 37% of our money? Why are our products being returned so much? They want to track this stuff. So my point, Dominic, and everybody, is on the test. You need to go into that test knowing that sales, gross sales, they may not call it gross, but it's gross sales less credit card fees, sales discounts, and sales returns equals net sales. On the test, you might get a question where they give you the sales revenue, they give you the net sales, and they give you two of these guys, and you have to squeeze the fifth one. Not hard, as long as you have that template clear in the old skull there, okay? Receivables, huh? Receivables. Accounts receivable. Take a look at this screen here. Accounts receivable. Another word for accounts receivable are trade receivables. Accounts receivable and trade receivables mean the same thing. They mean sales of your product or your service to a customer. Sales of your product or service to a customer on credit, typically 30 days, okay? There's no interest expense involved in that. There's no written contract other than maybe a purchase order. Trade receivables. Non-trade receivable might be if you're in a position to lend money to somebody. And I'll tell you another one I had for many years, employee advances. We used to give out, people would come, I'm short, Bob, can you give me $50? Probably never should have done it, but we did. It was never a problem. An employee advance would be an example of a non-trade, okay? Now, you ready to put the old thinking cap on? This is the toughest thing you're going to see for a while. You ready? Bad debts expense. Bad debts expense. This might surprise you, but sometimes people never pay their bills. They're crooks, or more likely they're in a financial position where they're unable to do it. Perhaps the company's going bankrupt. And we call that bad debt expense. And under GAAP accounting, generally accepted accounting principles, we don't wait until someone is unable to pay us and then record the expense. We have to estimate it in advance based on our best information. So what we're going to talk about here is recording your bad debts expense. It is an expense. Bad debt expense. So here they're making it real easy. They're giving us the number, okay? Deckers, the big shoe company, they estimated bad debt expense for 2017 to be $4,685,000. At the end of 2016, they sat down and they looked at their sales or the accounts receivable aging and made this guess. And it is a guess. It has to be a good faith, systematic and rational in accounting terms. So they have to write a journal entry. Take a look at this journal entry. In this part of the chapter, whenever you're dealing with bad debts expense, there are only 2 journal entries, two. And it can be still be a little bit confusing when you're seeing this for the first time. Let me talk about this one. When you record the bad debt expense, you only write this entry one time. You write this one time at the end of the month. It's an adjusting journal entry. The month ends and you're looking at your information and you decide that you need to have an allowance of $4,685,000, or at least add to that allowance. Let's put it that way. So look at this journal entry. Debit bad debt expense, credit the allowance for bad debts. That's one of just 2 entries in this section, but let's understand it. This is done at the end of the month, and it is an estimated number, an adjusting journal entry. Welcome to a new contra asset account called allowance for doubtful accounts. When we debit bad debt expense, we're estimating which customers today who owe us money are not going to pay us in the future. We don't know who the bad guy is at this point. We just have to make an estimate. We debit that expense. That's a selling expense, an operating expense, and we credit this account called allowance for doubtful accounts, a contra receivable account. Just like you had you had accumulated depreciation subtracted from the original cost to get net book assets. Here, you're going to take your accounts receivable minus the allowance, and that's going to be called net receivables. So I shall continue. So here's what we're talking about. Accounts receivable less the allowance for doubtful accounts equals net realizable value, or net receivables, I think sounds a little clearer. This is the amount they expect to collect. That's amazing, huh? Deckers doesn't expect to collect $4.7 million, huh? Maybe they did something wrong. Maybe not. We'll talk about that in a few moments. Okay, so the first journal entry, you debit bad debt expense, you credit the allowance. What you've done by doing that is adjust the net receivable amount to where it needs to be, okay? That's done once a month, only at month end. A write-off, you've heard that expression before. Where are they writing it off? They get to write it off. Write-off. When it is clear a specific customer account will be uncollectible, that amount comes off of the accounts receivable. Now we know who the person is. So we can go right to our accounts receivable aging and say, Dominic is not going to pay us. And then we can reduce accounts receivable with a credit and reduce the allowance for doubtful accounts with a debit. And let's see how that looks, huh? Now, Decker's estimated they needed an extra 4.7 million in their allowance. Wow, look how much we're actually written off during the year. Almost 7 million. The journal entry to record the write-off is da, 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 da. Come on, take a look at it. This is the write-off. This is the write-off. When we estimated that 4.6 million, we probably already had another 6 million in the allowance to begin with. So we had it covered. And now we find out. We were sitting around the office yesterday, and we went to a local restaurant to get a soda pop. And we looked up at the television. We saw Nicole being dragged out in handcuffs. It turns out her company was a fraud, and Nicole's in jail. We know at that point, no offense, Nicole, we know at that point that company is not going to pay us. There's no way they can pay us. On the news, they're saying this company doesn't have a dime. That becomes a write-off. You write it off with the allowance, debit to the allowance, which reduces that, and a credit to accounts receivable, which reduces that. This journal entry here has no impact on anything. It's just a reclass between two receivable accounts. And I'll show you what we're talking about. Assume before the write-off, Decker had 62 million in receivables, and the balance in the allowance account was 13. So 62 minus 13 is 49 million. That's how much they had before the write-off. Before the write-off. Now, remember that 6,969,000 we have to write off? They wrote it off. They pulled this bad customer out of the accounts receivable, reducing that, and they reduced the allowance. What was the effect on the net receivables? You can see it's 0. The net receivables are not affected by the write-off. The net receivables are reduced only when you debit the bad debt expense and credit the allowance. Okay, that's kind of an important point, not so much for trivia, but it kind of helps you understand things a little bit. And when we get further into this chapter, it does get a little bit tricky with what the numbers should be. But for now, let's be comfortable that we only have two two-line journal entries to worry about at this point in the chapter, okay? Bad debt expense and the write-off. Two methods. One is an easy method, but it's not a very good method. And I don't think many businesses use it. I don't know how they can really. And the other method is the one that 99% of the world uses. The easy one is the credit sales method. The sales method, credit sales. Easy. All you're going to look at are the sales for the end of the month. Okay, today is October 20th. When it gets to be October 31st, we see we had $1 million worth of sales. Our history tells us we lose, say, 2% of those sales. So we're going to take $1 million times 0.02, $20,000, and we're going to prepare that one-time adjusting journal entry. We're going to take those sales times 2%, and we're going to debit bad debt expense and credit the allowance for doubtful accounts. So here we go. Credit sales were 600,000. 1% is what they think they're not going to get paid. And you're done. This method is not too tough. When you use the sales method and you came up with the 6,000 number, what did you come up with? The bad debts expense. Sales method. You take your credit sales, not your cash sales. If there are cash sales mixed in, you must remove them. You take your credit sales multiplied by the company's percentage, and that becomes the bad debt expense for that month. That's not too hard, right, Suda?
I just need more practice.
What's that?
I said I just need more practice.
Okay. Did I wake you up, Suda? No, no,
No.
I'm sorry. Okay, we'll
It's all right.
continue. We'll continue.
I sometimes I have myself on mute, so my hands kind of stumble to like unmuted.
Okay, all right. I'll accept that excuse. No problem. All right. Credit sales method, pretty easy. But it's a bad method because it doesn't take into account people who are going bad from prior months. So let's take a look here. This is the method that is used in the world. I'm going to say that. The aging method. Here, we're not going to look at the sales at all. We don't care about the sales. We are going to every single month reinvent the wheel. We are going to compute. We are going to compute under this method, not the bad debt expense. We're not computing that. We're computing how much we need in the allowance for doubtful accounts. Think of that allowance as your allowance when you were a kid. Think of it as an allowance you get for your mother, but you can only spend it on school books or something. It is money set aside to cover future write-offs. So what we're going to do with the bad debt expense is we're going to look at the aging. We'll talk about the aging. And the number we compute under this method is not the bad debt expense. It's what we want in the allowance at the end of the month. And that's more than a subtle difference, okay? Okay, let's start up here. Take us through. Here's an example of an accounts receivable aging, an AR aging, okay? And this business might have hundreds and hundreds of customers, and they're just truncating it. They're just showing 3 or 4 of them, okay? So let's take a peek here, what we have. Aaron owes us a total of $235, Baxter $1,500, Clark, etc., and Zach. So let's go back up here. Aaron, he owes us $235, and it's in the 1 to 30 day column. So this means that he's a little bit overdue. Aaron is a little bit overdue. Let's take a look at Baxter. Baxter owes us $1,500. Well, we just sold him $1,200. This isn't even due yet. And this is just maybe slightly overdue, starting to worry about it. But look at Clark. Clark, he's gone 60 days, almost 90 days really, without paying us. His debt is getting older and older, and Zach is not too good. So what we're going to say to ourselves is, as the debt ages, so does our exposure to not collecting. So what we're going to do is we're going to look at each of these columns, and each company sets their own percentages. We're going to say if it's not yet due, we're only going to lose 1%. But once it lapses into the 1 to 30 day overdue column, then we got a problem. We think we're going to lose 4%, 10%, 25%, and once it goes out over 90%, over 90 days, you probably have a real big problem, okay? So you might have to bite the bullet and write some of this stuff off in the future. But now we're using this to compute how much we want in the allowance account. So we add these numbers up. We do our multiplying, we add them up, and we come up to a number, 1201, 1201. 1201 under this method is not the bad debt expense. It's what we want in the allowance account at the end of the month. And the difficult part of this chapter is determining the difference between the two methods and understanding that one computes the bad debt expense and the AR aging computes the allowance. Aging method equals allowance. How's that for a little hookup, huh? A and A. Aging method, allowance. So here we go. We came up with a balance of 1201. Now they're taking us into the journal entry. As of the end of the year, we already had $50 here. We already had a balance of 50. We want the ending to be 1201. Take a look. We had $50 credit balance if you're looking at a T account. We want the ending to be 1151. We already have 50. And there we get the desired balance. Anybody questions on this so far? Anything? No wisecracks, no input? If not, I'll continue. Here, take a peek at the T account, okay? Notice that the balance after the adjustment is equal to what we computed on the aging. And let me go back to the aging one more time. There is our computation of the allowance. The aging is the allowance. Aging is the allowance, okay? I'm going to give you another tip here. Anytime you see a credit to the allowance account, the debit's the bad debt expense. Anytime you see a credit to the allowance, you know the debit is the bad debt expense. That's a Bob tip. Okay. So here we go. They're going to take us through the calculation again. We're going to take the accounts receivable. Hey, Maria, how you doing? We're going to take the accounts receivable, multiply it by the estimated percentages, which is what we just did, the desired balance. Now we have the balance in the allowance, and we have to just squeeze the number. We have to plug it in there. And this is more confusing than anything. Here they're just saying if it's a credit balance, you're gonna have to credit it. If it's a debit balance, it means that you need to add it. I would not look at that. So what we just went over there is kind of the toughest part of this chapter. But if you can just divide and conquer that it's just those two journal entries and understand what those two journal entries are trying to accomplish, you have made a great stride forward. Here's a question. I have a company and my business does 10 million in sales, okay? And say, we'll pick on Maria since she just got here. And Maria has a company in the same business and her sales are 10 million. And we pretty much have the same profit margin. I decide that I'm not gonna sell to people unless I'm pretty sure they can pay us. Maria's company takes much more of a risk. They say, well, you know, this guy may not pay us, but we'll take a chance, and we'll take some chances. At the end of that year, Maria had hundreds of thousands of dollars of bad debt expense, and I had zero. Does that mean her company did better than mine? Anybody have any ideas about this? No ideas, huh? No. You know what happened? Maria's sales went from, what did I say, 10 million to 100 million. My sales went from 10 million to 10 million. The reason is Maria took a business risk. She checked these people out as best she could, and maybe she started them off with a little bit of credit, and once they paid that, kept extending. The point is you have to take a little bit of a risk. If you ever hear of somebody at a company bragging they have no bad debt expense, not necessarily a good thing, okay? That's just me. Good to know. Credit card discounts, sales discounts. Here we go. Now we're into the contra accounts, the contra revenue accounts. Credit cards, Decker's factory credit card sales were 3,000, a 3% fee. That sounds like $90 to me, right? So we never debit sales, never. You debit these contra revenue accounts. You debit the contra revenue account. In this case, that account is called credit card fees, probably. So what they're showing you here is the sale. Okay. Let me look at this real quick. The credit card sales with this, the credit card. Yeah, this is right. Someone walked into your store and they bought a $3,000 garment. You slap that thing into your cash register computer system, that credit card, and immediately it created this journal entry. It credited sales for the one garment times $3,000. Remember, your sales revenue is always going to be a multiple of the thing you're selling. If you sold 130, it would be 3,000, okay? But they're not going to get 3,000 in cash. They're only going to get 2,910 because of the credit card discount, okay? So just like with bad debt expense, companies who don't use credit cards because they don't want to pay the fee, you know, maybe biting their nose off to spite their face, as we used to say, okay? Credit card. So that's a pretty easy one. Key thing to understand, this is contra revenue. Contra revenue. Sales discounts. Now, some of you came on a little bit late, and we were talking about this before. A 2% 10 net 30 discount is worth 37% a year. And you can go back earlier in the lecture or see it in your book, what we're talking about. So Decker sold something on credit terms 210 net 30. Prepare the journal entry for the sale. I don't see the 2% there, nor should I. This is the point of the sale. Deckers sold $1,000 worth of boots on credit. This is from your first chapter, first two chapters, right? We sold something on credit, on account, as your book likes to say, instead of credit. We sold boots on account. And you know you can continue on account and nobody had money, which is what I tell you to say. So this customer now owes us $1,000 and we can recognize revenue of the same amount, $1,000, right? Now the customer paid us. We sold it on January 6th. Now the guy is paying us on the 14th. Is he entitled to receive the discount? And the answer, of course, is yes, he is. He has paid us within the 2% 10 time frame. So here we go. I'm afraid we're not going to get 3,000 in the mail. We're only going to get 980. We're going to get 980, and I'll go back to the calculation. It's simple as that. Guy bought $1,000 worth of goods. He or she is going to take the 2% discount, which is going to come out of the cash we might have otherwise collected. And there we go. There we go. Sales discounts, contra revenue account. Contra revenue. They have a debit balance because you never debit sales. What if the customer paid on the 20th? They're not entitled to the discount. They're not entitled to it. So that's pretty easy. You would collect the whole $1,000. What happens if a customer takes a discount and they're not entitled to it? And it happens a lot. What do you think the company might do about that? Nicole, you look like you want to say something, no? Not really? Okay. Okay. Here's what I'm getting at, guys. You have a customer who's a very good customer, and he always pays on time, and then one day he's late for some reason. He's a week late with the payment. You're probably not going to go after that money. You're not going to pester that person, right? And companies can get themselves in trouble if you have an overzealous, say, clerk working on receivables, and this is your biggest customer. He buys $1 million worth of stuff, and then one day he doesn't pay a $20 bill, and then he gets an invoice for the 2% that you want him to pay. No faster way to drive off a good customer. So you have to use common sense with these things. Sales returns. A customer returned $500 worth of boots, huh? Boots. And look at the second sentence. That's interesting. Deckers paid $300 for the boots. So Deckers went to a wholesaler and they bought this pair of boots for $300. And then they turned around and sold those boots for $500. So they made a little profit there, right? $200. So here we go. A customer returns. Customer returns it. We never debit sales. What contra account are we going to debit? I'll give you a hint. It's at the top of the screen. We're going to debit sales, returns, and allowances for $500. And we are going to credit accounts receivable because the customer no longer owes us this money. Okay? So let's take a look at that part of the entry. Look at that first entry there. There it is. The customer returned $500 worth of boots. Well, as soon as you know it's a customer return and you know you can't debit sales, you debit sales, returns, and allowances, and you credit accounts receivable. And we're okay on the sales side. But we have to consider this as well. What did we pay for those boots? $300. The customer is returning these $500 worth of boots, so there's no longer any cost to sales. We put the boots back in our inventory, right? A debit to inventory and a credit to cost of goods sold. We thought we had a profit of $200. Now we don't. We have no profit. We have no entry. That should make a little bit of sense. You can do this in a 4-line journal entry or break it out into 2 here. But you have to consider anything returned becomes your inventory again. We're going to sell those boots, hopefully, to somebody else. Those boots were made for walking. Just remember that. Nobody knows that song. Oh, what up? You young people, you drive me nuts. Okay. Okay. Now we're out of the harder part of the chapter, huh? We're out of the harder part of the chapter, I think. Now we get into cash and cash equivalents. Cash. Cash is the coin. Cash represents the coins in your pocket and the grain bills, those hundreds we're all walking around with here. Money order, a bank draft, a treasury bill under 3 months, a certificate of deposit. Direct deposit would be an example. And credit cards are cash. Credit cards are cash. And guess what? Guess what? Cash is an asset people like to steal, huh? Who knew? So we're going to talk a little bit about what are called internal controls. These are your systems and policies designed to account for your assets. I'm sorry, I got the happy fingers here. Properly account for assets, safeguard them, and thus ensure the accuracy of your statements. Cash. One of the easiest things with cash is at the end of the day, you lock it up in a safe. It sounds silly to say that, but that is an internal control that is a good one to help protect your cash. You might have a petty cash box on a desk, and the control is that the person who's in charge of petty cash must have it under lock and key inside a locked drawer until he or she needs it. Cash is the asset most susceptible to theft and fraud. We're going to talk a little bit here about separation of duties. Separation of duties. The person who prepares the bank statement, perhaps, should be different from the person who takes the money to the bank, should be different from the person who opens the mail, should be different from the person who writes the journal entry. You get the idea. You want all these jobs done by different people so that if anyone tries to cheat, you have three other checks on them in a way. You don't want the same person doing everything. Now, in smaller companies, it's hard. You may not even have 4 people. But my point is you want to segregate, separate the duties. And I'm going to launch into my favorite anecdote about a true story here in Santa Barbara about 10 years ago. Terrible. I feel bad for the lady, but she made her own bed. A woman graduated from high school out here, I believe, and went to work for the police department. And she started in the office and she did good work for a few years, and they promoted her. And, you know, she was there 25, 30 years, and they trusted her. She was a great employee, and she was totally honest. And they gave her the job. They said, look, why don't you handle all this? You handle everything in regard to traffic fines. You record the traffic fine in the system when you get it from the cop. We'll have the people mail their fines to you. You enter them into the system. You take the money to, do everything. They eventually found that she stole millions and millions of dollars before anybody knew a penny was gone. And the way she did it was, I got one of those pesky $40 parking tickets downtown. We've all been susceptible to those. I got the ticket. I sent my $40 to the police department. She got the money, put it in her bank. And at the same time, because she was in charge of the computer, she would just delete the ticket like it never happened. My point
Wouldn't
is,
sorry, Bob, wouldn't her bank account show that she has all of this incoming cash
yeah, but
deposit?
nobody was looking at her bank account, sir. Not at that point.
I would think the bank would somewhat be flagged.
Well, you raise a good point. And in fact, when we get done, before the end of today, you got me thinking. I'd like to look up those articles again in the local papers and see just how they caught the woman. That could be how they did it. In other ways, Suda, they maybe didn't look at her bank account, but what if she showed up for work driving a Rolls Royce?
True.
That would be a clue too, So separation of duties. And one last thing you might find interesting. You always want the accounting people to take their vacation. If you have someone in accounting who never takes a vacation year after year, that's very suspicious because they're trying to cover this stuff up, okay? But anyway, she was convicted and she went to jail for quite a long time. Segregate. Hey, bank reconciliations. They got this under internal control. Bank reconciliation. I don't think I'm exaggerating when I say this could be the most important report a company does every month for each of their bank accounts. The bank reconciliation. At the end of the month, your checkbook says you have $50,000 in the bank, okay? You have $50,000 in the bank. The bank statement comes, and now there's only $12,000 on that same date. Is that a problem? Probably not. Probably not, due to timing. There are certain things that that the bank doesn't know. And what I'm talking about are deposits that you put in the mail on the 31st of the month. You put a deposit for, say, $20,000 into your journal entries, into your general ledger, so you have the money recorded, but the check is on its way to the bank. The bank doesn't know anything about it. That's called a deposit in transit. Same thing with checks you get from customers. Those are checks from customers. Same thing with checks you write. You have a salesman in your office and you give him a check for $50 as a repayment of gas on the car or something. And he puts that in his wallet and he forgets about it for a few months. That's money that you have in your financial statements that's not yet in the bank. So the bank reconciliation means just that. It's bringing the two balances together to assure that we come up to the same adjusted bank balance, okay? bank statements. Explain the difference. It explains the difference between the cash on the bank statement and the cash on the company's books or general ledger. And then it might tell us what journal entries may be needed, okay? This is the basic template. This is the basic template. When you're trying to do a bank rec in this class, have this type of thing in front of you, and you'll see other templates as we go along for the next few minutes here. Let's start with the bank side. The bank. You're going to say up in this first line, this is the balance per the bank statement. The balance as of October 31st, 2020. That's the balance. And then you're going to look at your general ledger, and you're going to see that some of the customer payments that you recorded are not at the bank yet. Those are called deposits in transit. So we have to add that to this bank balance. We must do the same thing with the outstanding checks. Outstanding checks are checks we wrote that have not yet cleared the bank. I would ignore bank errors. I don't even like to talk about that. Bank errors just don't happen really in the world for the most part. It just confuses things. We're the ones who make the errors, the companies. So bank side, balance plus deposits and transits minus outstanding checks equals what they're calling the correct balance or the adjusted bank balance. So what have we done here? We have taken the bank balance and then we told the bank on paper, we told the bank things the bank didn't know. The bank didn't know these stuff was in the mail. So this is what the bank should have at this point. But the bank knows things we don't know. So we start now with the general ledger, balance per general ledger per books. And maybe there was a direct deposit from somebody we did not know about. They're calling it a credit memo. You know, maybe somebody mailed their payment directly to the bank and the bank put that money into our account. Maybe we looked at the bank statement and there was a service charge, a bank fee, or an NSF check, NSF, non-sufficient funds, a check that went bounced check. A bounce check is a check written by our customers. We deposited it in the bank, and then the bank rejected it when they realized that there was no money to cover it. This is an important distinction. Everything on the bank side, maybe I should use positive words. Everything on the book side, all these items require a journal entry. Any reconciling entry on the general ledger side requires a transaction. We did not know the bank collected a payment from Dominic's company. It was a direct deposit. Now we can record it. We looked at the bank statement and they charged us $40. And then there was a bounce check. That's money we thought we have and we don't. So let me take you through this example of a bank rec and then we'll pretty much call it a morning, okay? Bank reconciliation. This company, Simmons Company, balance per the bank, 9610, balance per the ledger, 7430. So we can set up our template just like you see it here. And then they're giving us some other information. But let's start with those balances. Ta-da! You got partial credit already, huh? Just make sure you put the right number under the right entity. The bank balance was 9610, and the balance per our general ledger was 7430. Okay. All right, let's see. They gave us that. Now they're giving us some other information. So let's divide and conquer here, huh? They're making this one easy, but if you can do this one, you can do any of them. Outstanding checks total 2417. What's an outstanding check? A check written by our customer that we added to our general ledger, but the bank doesn't have. No, I'm sorry. Outstanding check is a check we wrote. Oh, forgive me. Outstanding check, a check we wrote, the bank hasn't got. This $500 one is a check written by customers, okay? That is a deposit in transit. So let's see what they did with that 2417 and 500. Well, here it is. The outstanding checks were 2417. They gave you that number, and they gave you the 500 there, deposit in transit. They're telling you about this error on the bottom. They're saying that the bank made a mistake. They gave us too much money. Now they're taking the money away. So I would never give a problem like that, and I'm almost guaranteed you're not going to get a question. You will get a calculation though with an error, but the error is going to be the company. Not that the banks are infallible, but they don't often give away money by mistake. Okay. So what did we do here? We just reconciled the bank side. The bank says 9610. Well, they don't know about this deposit in transit, a check from our customers. They don't know we wrote a whole bunch of checks the last day of the month that have not arrived yet. And they gave us too much money. We're in a position here, supposedly we call the bank and say, that's not our money, okay? That's what this is saying. So we're coming up with what they're calling a corrected cash balance, more properly known as the adjusted bank balance, okay? So let's go back to the start again. The bank balance was 9610. So let's see if there's things here that the bank knows that we don't. Let's see. Well, the outstanding checks, that's our knowledge, the 500. Uh-oh, there was a bounce check. We earned some interest. Hey, we didn't know that until we got the bank statement. And now here is the type of entry that can be made. We wrote a check that cleared the bank for $268, but we only recorded it as $240. Now, don't ask me how you make that mistake, but it can happen. We sat down and we wrote a check for $268. We wrote it out in pen and we handed it to the person. And then when we went to put it into our books, we typed it in as $240. Work with me on that one, okay? So what do we have here? We have a bounce check, we have interest income, and we have an error. Here we go. Bank book balance, 7430. Oh, let me get rid of that. Balance per the ledger, 7430. And then we had this $30 fee here, the interest income. We had the bounce check for $225, I believe that is. And then we had that $28 error. That's the $268 minus the $240. We wrote the check for, come on, we wrote the check, oh, for heaven's sake. It cleared the bank for $268, but we only wrote $240 in our records. So that's $28 we no longer have. We get to the end of this thing, and there we go. We have now reconciled the bank statement. And I think you can get a feel for why this is so important. Okay? Why this is so important. Suppose we put this together and we found out after bringing the bank information over that this number 7207, this looks absolutely right to us. Or rather, the 7207, our side looks right to us. But when we did the bank side, we only had $1 here instead of 7207. Guess what? Somebody might have gotten away with something. You know, they'll say, well, who did the bank reconciliation? They said, Maria did. Okay, well, let's ask Maria about it. You go to Maria's desk. Oh, Maria said she's on vacation for the next 3 months. She's going to Afghanistan. You get the idea. If this thing does not equal, you do have a problem. You have a pretty severe problem. And there are companies who kind of don't do these every month, and maybe they're taking a risk. I don't know. I don't think Maria would go to Afghanistan. So there's the bank reconciliation. Remember what we said. Anything on the bank side, we ignore in terms of a journal entry. Here is what we have to record. We have to record this income. We have to put back this bounced check, and we have to fix this error. Now we have to prepare these. I don't want to know if we want to call them adjusting journal entries, but they are, I guess, in a way, adjusting entries. These are journal entries required as a result of the bank reconciliation. And I'll give you a hint. Every adjusting entry, every entry resulting from the bank reconciliation is a debit or credit to cash. And what drives me nuts teaching this class, I put that down as a true-false question. True or false? Every entry in reconciling the journal entry involves a debit or credit to cash, and half the class says no. which tells me half the class is guessing. But let's take a look at it, all right? Let's take a look. They broke out the revenues from the expenses. Cash. We looked at that bank statement, and there was a $30 income boost, interest income. Hey, that's great. We found $30 we didn't know we had. Debit that, credit revenue. Uh-oh, we had that bounced check. Uh-oh. Well, we have to credit cash for $225. And the reason we're debiting accounts receivable is that now that customer owes us the money again. Because when we got paid, we debited cash and credited AR. So we just have to reverse that portion. So you're going to have a debit to AR and a credit to cash for $225. And then on the $28 mistake, they're just pretending that they bought supplies. In other words, when they paid that money out, they debited supplies inventory, but they didn't debit it enough. Okay. Receivables turnover. I'm just going to talk about this briefly. Have you received your 2 FSA companies yet?
No.
Oh, I'm going to talk to my boss. I mean, I'm only supposed to do.
I think it's toward the end.
Pardon me?
I think it's toward the end.
Not really, Sue. It should start with this chapter, actually. Although, it could be, you're not going to do the FSA at all. Is that possible? Or it's going to be a shorter one due to the, due to the constraints. You heard something, Maria?
Yes, I was checking the syllabus yesterday, and then we have the next exam next week, I think. On Tuesday, and then the 2 financials statements are at the end.
Yeah,
Start
it's like
after-
November 15.
Okay, you're right then, Suda. I stand corrected, as you can tell by my orthopedic shoes. How's that for an old bad joke, huh? I'll let you think about that one for a while. Anyway, the receivables turnover. You were going to take the net sales, credit sales, right? Credit sales, and divide them by the average AR. I'm not going to get into this in too much detail now, because this is really more for when you get to the FSA. But understand what we're saying here. We divide our sales by the average AR, meaning the balance at the beginning of the year plus the balance at the end divided by 2. And we come up with what's called the turnover. Wow, look at these shoe stores. Turnover. Decker's 7.6, same as Timberland. Skechers a little bit less. Turnover. What do we mean by turnover? It's just an expression of how many times you sold, or in this case, how many times you collected your average receivables. Turnover. It's still kind of vague. You go into a meeting with your boss, and I know this from experience, and we're looking at stuff, and the boss says, well, what happened with the receivables? I said, well, boss, we had a 7.6 turnover. And the boss could be a graduate of Harvard Medical School, and he may not know what you're talking about. What do you mean turnover? What does that tell me? Well, it tells us how often we sold the average AR. And he'll still look at you. So here's what we're going to do. We're going to turn that into everyday language. We're going to take that turnover of 7.6 and divide it into a year. 365 days divided by 76 equals 48 days. That means that this company collects on average in 48 days from billing. You ship your product on March 1st, and you're going to get paid around the middle of April. Okay? 48 days. It takes them 48 days to collect cash from their credit customers. Is that good or bad? I imagine it depends on the business. Terms are usually 30 days, but in my whole world, I've never ever seen the days collected go below 30. Very few people pay in advance. I mean, some do, but people like to hang on to their money. So if you're collecting in 45, 48 days, that might not be too bad. Our target at Thomas and Betts all those years was always 45 days. We wanted to collect in 45 days and then pay in 60. And that's pretty typical, okay? Here we go. I know you're very disturbed that this has come to an end today, huh? All right, Maria, what do you have to say? What do you have to say for yourself, Maria?
Well, I just checked the financial accountant again, and one is due on November 15th, and the other one is due on December 6th.
So there's just two?
Yes.
Okay, yeah. The first one is gonna be what we just talked about, plus the component percentages and time series analysis. Is that what it says?
Yes.
Okay, and then the second one will be along the lines of return on investment, return on assets. Any questions, Nicole?
Is my mic working?
Say what?
No. Is my mic working?
I hear you.
Yes.
Yeah. Okay. Because earlier I was talking, but I don't think you could hear me.
I just wasn't listening to you. I'm only kidding. No, I didn't hear you earlier. Just go ahead. I'm sorry.
It's okay. So I didn't know if I had to log back out and log back in.
I'm here for you.
But no, I think I actually get this chapter.
Okay.
I think it's one that I
Okay.
get.
Yeah,
that
it's not the hardest thing in the world, but just that stuff with the bad debts expense, understanding the two journal entries and why we're making those entries. One to come up with the expense, the other the allowance. How about that, Dominic? Did we help you out here?
Yeah.
You hung in there for the whole thing, huh? All right. And who's the last person? Suda, why don't you talk for a few minutes?
I'm good, thank you.
Can I ask you where you're from, Suda?
I'm from Thailand.
Oh, you're the one from Thailand. Okay. Hey, can
Yeah,
I tell you a quick story? This is actually a true story from not this past
sure.
last Christmas. I had a very good student from Thailand, Benjamin, his name was, real nice kid.
Mhm.
And he was doing real good in my class. And then there was a girl from Thailand who came to me for tutoring all the time. And, and then I wasn't playing matchmaker, but I brought Ben downstairs. And while she was there, I said, hey, Ben, this is Jane. Jane, this is Ben. Both of you guys are from Thailand. So they started to talk in their language. And I could, they were laughing. And I went home. I was done for the day. I don't know if Maria heard the story. I came back the next day and the campus was buzzing because it turned out they knew each other back in Bangkok in grammar school and high school.
How
They
fun.
had no idea that they were running. So it's
That's
quite
cute.
the amazing coincidence, you know?
Yeah, but I'm from a small town on the southeastern part of the country.
Okay.
So my dialogue is a lot different than the
Oh,
rest
really?
of the. Yeah.
Oh, interesting. Okay. Well, our president pronounces it Thailand. You probably heard that on the news, no?
H is silent. Let him know.
Well, tell our president, okay? All right.
Yes.
Well, I'll let you all go, okay?
Yes.
And I don't know if I need to trim this to avoid the anger of a certain boss here. So, okay, take care, everybody. We'll see you on next, what is it? Friday, right? We're back Friday. Bye-bye.
All right, bye.
Bye. Thank